Not tomorrow, not in some distant future, but quietly, mathematically, already in motion, because when headlines celebrate power and politicians speak of strength, the cost is almost never paid by institutions. It is paid by households, by savings, by purchasing power. What if the largest asset seizure in modern history was never designed to fix the system, but to delay its collapse? What if this was not a rescue, but a signal? A signal that the currency is weakening, that debt has crossed the point of return, and that ordinary citizens will be asked to absorb the loss. This is not speculation. This is pattern. This is arithmetic. And once the numbers are understood, the outcome becomes unavoidable. Because history shows, when empires seize assets, the public always pays the bill. Pas un power. Welcome to Hidden Currency. If you believe experience matters more than noise, and preparation matters more than reassurance, consider subscribing, not urgently, not emotionally, just thoughtfully, like someone who has lived long enough to know that systems change quietly before they change loudly. And tell us, from where in the world are you watching today? In early January 2026, headlines around the world told a familiar story. A decisive operation, a fallen regime, a foreign president removed in the name of stability, democracy, and global security. To the casual observer, it looked like strength. To financial markets, it looked like confidence. To policymakers, it was framed as control. But beneath the headlines, a different story was unfolding, one that did not appear on television screens or political speeches. A story written not in ideology, but in numbers, not in emotion, but in balance sheets. At the center of this story was a single event, the effective seizure of assets valued at approximately $17.3 trillion. Proven oil reserves, physical resources, and strategic infrastructure were brought under foreign control almost overnight. On paper, this appeared to be a victory, a gain, a strengthening of national power. Yet history shows that empires rarely seize assets at moments of strength. They do so when internal systems begin to weaken. The operation was presented as a solution, but in economic terms, it behaved more like a signal that the existing financial structure was under strain, a signal that the currency backing the system was no longer sufficient on its own, and most importantly, a signal that the costs of maintaining stability were being shifted away from institutions and toward the public. To understand why, one must first understand how modern states finance themselves. Governments do not operate like households. When spending exceeds income, a household must cut costs or borrow. Governments, especially those issuing reserve currencies, take a third path. They issue debt. That debt is absorbed by markets, foreign governments, pension funds, and central banks. As long as confidence remains high, this system can continue for years, even decades. But confidence is not permanent. It depends on credibility, discipline, and productive capacity. When spending consistently outpaces revenue, debt grows faster than the economy. Interest costs rise. Servicing old obligations requires new borrowing. Over time, the system becomes dependent not on growth, but on belief. This is where asset seizures enter the picture. When a state acquires hard assets, oil, minerals, land, it gains something tangible. Unlike currency or bonds, these assets hold intrinsic value. They can be sold, leveraged, or used to support trade. In theory, they strengthen the balance sheet. In practice, they often serve a different purpose. They allow governments to project strength outward while postponing reform inward. They provide short-term relief without addressing long-term imbalance, and they create the appearance of solvency without restoring it. For the public, this distinction matters deeply. Asset seizures do not erase debt. They do not reduce deficits. They do not lower interest obligations. Instead, they introduce new costs: infrastructure spending, security, political risk, and long development timelines. These costs are rarely paid up front. They are financed, and financing always has consequences. When governments expand their balance sheets without increasing productive output, the burden shifts through inflation, taxation, or currency debasement. Prices rise gradually. Purchasing power declines quietly. Savings lose value without an official announcement. This is how impoverishment happens in modern systems, not through collapse, but through erosion. Most citizens never see a single dramatic moment. Instead, they notice that wages no longer stretch as far. That housing becomes less affordable. That energy, food, and insurance costs rise faster than income. They feel pressure, but are told the economy is strong. From the outside, it appears contradictory. From the inside, it is mathematically consistent. The asset seizure was not designed to enrich the public. It was designed to stabilize confidence at the top of the system. Markets needed reassurance. Creditors needed proof of strength. Allies needed signals of control. The public needed none of these. What the public needed, fiscal discipline, sustainable growth, and structural reform, remained untouched. History provides many examples of this pattern. Empires near the midpoint of decline often turn outward in search of resources. They expand not because they are strong, but because they cannot contract politically. Cutting spending, reducing entitlements, or restructuring debt creates immediate backlash. External action delays that reckoning. But delay has a price. The price is time bought at the cost of future purchasing power. It is stability today, exchange for pressure tomorrow. And the bill is not sent to governments. It is distributed across society. This is why the $17.3 trillion figure, while enormous, misses the point. The question is not how much was seized. The question is why it was necessary at this moment. And once that question is asked, a deeper reality emerges. The seizure did not signal dominance, it signaled dependence. Dependence on assets to support a system no longer supported by its own fundamentals. For business leaders, entrepreneurs, and decision makers, this distinction is critical. Because systems that rely on asset grabs eventually rely on their citizens to absorb the adjustment. And that adjustment has already begun. By the time the public begins to argue about motives, the outcome is already determined. Economic systems do not collapse because of opinion. They shift because of arithmetic. And arithmetic does not respond to speeches, elections, or intentions. It responds only to inputs and limits. In this phase of the cycle, narratives multiply. Every policy action is explained as temporary. Every warning is dismissed as pessimism. Growth projections are adjusted slightly upward. Risks are reframed as opportunities. The system appears busy, active, and managed. But behind the activity, the numbers move in one direction. Government spending continues to exceed revenue by large margins. Debt does not stabilize, it compounds. Each year's shortfall becomes next year's baseline. Interest costs grow quietly at first, then rapidly. What once felt manageable becomes structural. This is the moment when policymakers stop speaking about balance and start speaking about scale. Large numbers create comfort. Trillions sound abstract. Percentages soften reality. When the public hears that debt has increased by a few percentage points, the impact feels distant. But when interest payments begin to rival core public services, the system enters a new phase. At that point, choices narrow. Raising taxes at scale risks slowing economic activity, cutting spending risks, social instability, default risks, global confidence. That leaves one option that avoids immediate confrontation: dilution. Dilution does not require an announcement. It does not appear as a policy failure. It appears as higher prices, lower real wages, and reduced purchasing power. It spreads the cost across the population without identifying a single payer. This is why inflation is politically tolerated long before it is publicly acknowledged. Asset seizures fit into this strategy. They create the illusion of balance, while dilution does the work of adjustment. Physical resources can be listed on balance sheets. They can be referenced in speeches. They can be used to reassure lenders. But they do not change cash flow dynamics. Oil in the ground does not pay interest on debt. Minerals do not fund entitlements. Infrastructure does not cover deficits unless it is productive, operational, and profitable. And even then, timelines matter. 15 years of development does not solve a problem that compounds every 12 months. For businesses, this distinction is crucial. When systems move from narrative management to numerical pressure, behavior changes. Capital becomes cautious. Investment horizons shorten. Risk premiums rise. The cost of money increases, even when policy rates appear controlled. This is how financial stress spreads without panic. Entrepreneurs feel it first in credit conditions. Banks tighten standards quietly. Terms change. Collateral requirements increase. The language shifts from growth to resilience. Expansion plans are delayed not because of fear, but because projections no longer clear internal thresholds. Meanwhile, households experience a different version of the same math. Income grows slowly. Expenses grow faster. Savings generate less real return. Insurance costs rise. Housing becomes harder to access. The public is told the economy is expanding, yet daily life feels more constrained. This disconnect is not accidental. It is structural. The system is absorbing pressure through the broadest possible base, the currency itself. Each unit of money carries slightly less value than before. No single transaction feels dramatic, but over time, the effect is undeniable. This is where asset seizures reveal their true function. They are not tools of prosperity. They are instruments of delay. They extend the timeline by borrowing from the future. They provide cover while the adjustment is transferred to purchasing power. Historically, this phase lasts longer than expected. Confidence does not disappear overnight. It erodes unevenly. Some sectors thrive, others stagnate. Inequality widens not because of intent, but because access to assets protects some, while exposure to currency weakens others. Those closest to financial flows adapt first. They shift toward real assets, pricing power, and mobility. Those tied to fixed income or domestic consumption feel the pressure last, but hardest. The public is often told this is normal, that cycles exist, that patience is required. What is rarely said is that once dilution becomes the primary adjustment mechanism, Reversal becomes difficult. Restoring purchasing power requires either contraction or discipline, both politically costly. So the system chooses continuation. From the outside, it looks stable. From within, it grows more fragile, not because of a lack of resources, but because the resources no longer solve the underlying imbalance. This is the stage where attention matters. Because when numbers replace narratives, those who understand the math do not wait for announcements. They adjust quietly. And those who do not pay gradually. The asset seizure did not change the direction of the system. It confirmed it. What comes next is not collapse, but transition. And transitions always decide who absorbs the cost. Economic shifts rarely announce themselves with alarms. They move silently, through incentives rather than force. By the time the public recognizes the change, the adjustment has already occurred. What follows is not a crisis moment, but a redistribution phase, slow, uneven, and difficult to reverse. This phase is best understood not as failure, but as transfer. When a system can no longer correct through growth or discipline, it corrects through reallocation. Wealth does not disappear, it changes hands. And the mechanism of that transfer is rarely explicit policy, it is structure. At this stage, the rules of the economy begin to favor position over effort. Those who control assets gain leverage. Those who depend on wages or savings lose ground. The system does not punish productivity, but it stops rewarding it proportionally. This is why inequality widens during periods of monetary strain. Asset holders benefit from rising prices. They can adjust rents, fees, and margins. They can borrow against appreciating collateral. They can protect value by owning what others must pay to use. Meanwhile, currency holders experience erosion. Their income lags. Their savings lose real value. Their costs rise regardless of performance. None of this requires malicious intent. It emerges naturally when currency is used as a buffer. The asset seizure fits squarely into this dynamic. By emphasizing control over physical resources, the system signals which side of the equation will be protected. Assets are elevated. Currency is diluted. Access becomes more important than participation. For young entrepreneurs, the shift is subtle but decisive. Traditional assumptions break down. Hard work alone no longer guarantees progress. Cash flow matters more than profit. Pricing power matters more than volume. Balance sheets matter more than income statements. Businesses that rely on fixed pricing struggle. Businesses tied to real assets, energy, infrastructure, commodities, logistics, gain resilience. The economy does not shrink uniformly, it reorganizes. This is the quiet transfer at work. Public discourse often misses this phase because nothing dramatic appears to happen. Markets fluctuate, but do not collapse. Employment remains high, but job quality changes. Consumption continues, but through debt rather than income. The stress is distributed. Governments prefer this outcome because it avoids visible disruption. There are no emergency measures, no explicit defaults, no formal restructuring. Instead, time does the work. Value moves from those unable to adjust toward those who can. Historically, this phase can last many years. In previous empires, it took decades for the public to realize that the standard of living had permanently shifted. The currency still existed, institutions still functioned, but the economic ladder had moved, the middle compressed, mobility slowed, stability became conditional. What makes this phase dangerous is not poverty, but complacency. People adapt to decline gradually. Expectations adjust downward. What once felt unacceptable becomes normal. And because the change is slow, resistance remains fragmented. The asset seizure reinforces this process by anchoring policy around resources rather than reform. It sends a message to markets that value will be defended through control, not balance. That message shapes behavior. Capital responds quickly. It flows toward protected sectors. It avoids areas exposed to dilution. It seeks mobility, optionality, and insulation. Labor does not move as easily. For the public, this creates a widening gap between economic participation and economic outcome. People work more hours, but capture less value. Productivity improves, but compensation stagnates. The system appears functional, yet feels increasingly restrictive. This is not accidental. It is how large systems adapt when correction becomes politically constrained. From a strategic perspective, this phase separates awareness from outcome. Those who recognize the transfer early can reposition. Those who do not become the source of adjustment. The key insight is simple. When governments prioritize asset control over monetary stability, they reveal where protection lies, and protection determines winners. This is not a call to panic. It is a call to clarity, because once the transfer phase is complete, it cannot be reversed without disruption. The distribution becomes embedded. The new normal sets in. The question is not whether this process will occur. It is already underway. The question is who understands it in time. Every economic cycle reaches a point where outcomes are no longer debated, only distributed. By the time this stage arrives, the system does not need dramatic events to enforce change. Behavior has already adjusted. Incentives have already shifted. The direction is set. This is where the final consequences of asset seizures become clear. The seizure itself was not the end of the story. It was a marker, a point on the timeline showing that the system had crossed from management to preservation. When preservation becomes the priority, growth becomes secondary. Stability is no longer about expansion, but about control. For governments, this means narrowing options. Capital controls become more likely, even if they are not called that. Regulations increase, tax structures shift, reporting requirements expand. Mobility is subtly reduced. None of this happens suddenly. Each change is justified individually. Together, they form a barrier. This is how systems slow capital escape without announcing it. For the public, the effect is delayed recognition. Most people assume that tomorrow will resemble yesterday. They plan based on continuity. They trust that institutions will adjust before conditions deteriorate significantly. History shows otherwise. Once a system relies on asset grabs and currency dilution, reform becomes increasingly difficult. Political incentives favor postponement. Short-term relief wins over long-term correction. Leaders rotate. The structure remains. At this stage, the role of the individual changes. Citizens are no longer participants in growth. They become shock absorbers. Their purchasing power, savings, and labor flexibility are used to smooth systemic stress. This is not a judgment. It is a function. Entrepreneurs face a sharper reality. Markets no longer reward innovation evenly. They reward positioning. Businesses aligned with inflation-resistant inputs, pricing power, or essential demand gain leverage. Others face margin compression, regardless of effort. The economy continues to function, but opportunity narrows. This is where preparation diverges from reaction. Those who wait for confirmation miss the window. By the time policies are openly restrictive, repositioning becomes costly or impossible. By the time inflation is officially acknowledged, asset prices have already adjusted. By the time the public is warned, the transfer is complete. This is why serious decision-makers focus on signals, not statements. The $17.3 trillion asset seizure was one such signal. It did not solve a problem, it revealed one. It showed that the system had moved from sustaining itself through productivity to sustaining itself through control. Once that shift occurs, outcomes follow a familiar path. Currency weakens relative to assets. Domestic savers lose ground to global holders. Mobility becomes an advantage. Optionality becomes a form of insurance. Exposure becomes risk. The final stage is not collapse. It is consolidation. Wealth concentrates not because of conspiracy, but because the structure rewards proximity to protection. Those closest to assets, information, and flexibility retain value. Those farthest absorb adjustment. This is the point where strategy matters more than optimism. Preparation does not mean withdrawal from the economy. It means understanding how the economy is changing. It means recognizing that nominal growth can coexist with real decline. It means measuring success in purchasing power, not income. The public is often told that resilience means endurance. In economic terms, resilience means adaptability. The door does not close suddenly. It narrows gradually. Each year, fewer options remain. Each cycle reduces margin for error. Each delay increases dependence. The asset seizure accelerated this narrowing. It confirmed that the system would defend itself through external means rather than internal correction. And when systems choose that path, the cost is never evenly shared. The final question is not whether the public will be affected. That outcome is already determined by structure. The question is timing and awareness. Those who recognize the phase can act while flexibility exists. Those who rely on reassurance will discover too late that stability was temporary. This is not a forecast of disaster. It is a description of transition. And transitions reward those who move before they are forced. The story of the asset seizure is not about foreign resources. It is about domestic consequences. And those consequences are now unavoidable.